April 1st, 2020. While the world was locked down, dealing with market chaos and uncertainty, one man was walking out of prison with nothing but the clothes on his back. No trading experience, no financial background, just a burning desire to change his life. Fast forward 16 months. That same man had transformed $30,000 into $3.5 million. Today, his account sits at over $10 million. This isn't a fairy tale or some get-rich-quick scheme gone right. This is the story of Ariel Hernandez and what his journey reveals about the psychology of trading success that most people never understand. But here's what makes this story truly remarkable. It's not just about the money. It's about the mental framework that allowed someone starting from absolute zero to outperform seasoned professionals. And more importantly, it's about the psychological trap that nearly destroyed everything he'd built, and how understanding that trap can make or break any trader's career. I'm going to share with you the 3 critical psychological principles that separated Ariel from the thousands of other traders who started in that same volatile period and failed. Because after 15 years of professional trading, I've seen brilliant people destroy their accounts, and I've seen unlikely candidates achieve extraordinary success. The difference isn't intelligence, capital, or even luck. It's psychology. The foundation, starting with nothing to lose. When Ariel stepped out of prison in April 2020, he possessed something that most traders never have: the psychology of someone with absolutely nothing to lose. Within 2 weeks, he was hearing friends talk about making hundreds of dollars a day on their Robinhood accounts. But instead of dismissing it or jumping in recklessly, he made his first psychologically sound decision. He recognized his own ignorance. This is where most new traders fail. They see success stories and immediately assume they can replicate them without understanding the fundamentals. Ariel spent his first month making $3 and $5 trades, not because he was being conservative with money, but because he was being conservative with his learning process. He was building what I call psychological calluses, the mental resilience that comes from experiencing real money pressure in small, manageable doses. By June 2020, he had made his second critical psychological decision: full commitment. He didn't dabble. He didn't keep a backup plan. He sold his motorcycle, his Rolex, everything he owned to fund a proper trading account above the pattern day trader rule. This wasn't recklessness. It was the psychology of total commitment that separates successful traders from hobbyists. But here's what most people miss about this phase. Ariel spent those early months treading water, as he called it. July, August, September, basically breaking even. Most traders would have quit. They would have seen the lack of immediate success as proof that trading isn't for them. But Ariel understood something crucial about the psychology of skill development. Competence comes before confidence, not the other way around. He was learning order types, understanding VWAP, figuring out how to add moving averages to charts. These aren't glamorous skills, but they represent the psychological foundation that would later support millions in profits. Most traders want to skip this phase. They want to jump straight to the big wins. That's the first psychological trap. The breakthrough: understanding market psychology. By October 2020, something clicked for Ariel. He discovered what he called sympathy plays. But what he was really discovering was market psychology at its most fundamental level. When GME exploded, smart money didn't chase GME. They identified AMC, EXPR, and other related stocks that would move in sympathy. This reveals the third psychological principle. Successful trading isn't about predicting the future. It's about understanding human behavior. When traders miss a big move, they experience FOMO, fear of missing out. They start looking for the next one. Ariel learned to position himself ahead of this predictable psychological pattern. But here's where it gets interesting from a trading psychology perspective. Ariel wasn't just finding these sympathy plays through technical analysis. He was using tools like FinViz to identify solar stocks when solar names were running, semiconductor stocks when chips were hot. He was thinking systematically about how trader psychology creates opportunity clusters. The breakthrough came when he realized that if he got a 30, 50, or 100% move in a single day, It was fairly predictable. That word, predictable, reveals something profound about his psychological evolution. He had moved from hoping and guessing to understanding and anticipating. That's the mindset shift that separates profitable traders from gamblers. During this period, Ariel was making increasingly aggressive bets, scaling his position sizes as his confidence grew. $7,000 weeks became $15,000 weeks. This is where most traders destroy themselves. They mistake a hot streak for invincibility. But Ariel had developed what I call percentage thinking. He understood that an $80,000 loss hurt the same whether his account was 1 million or 10 million. It was always about the percentage, never about the absolute number. This psychological framework, thinking in percentages rather than dollar amounts, is what allowed him to scale from 30,000 to 3.5 million in just 16 months. Most traders get emotionally attached to dollar amounts. They can't risk 50,000 because 50,000 is a lot of money. But if 50,000 represents 2% of a $2.5 million account, it's exactly the same risk as risking 1,000 on a $50,000 account. The trap, when success becomes dangerous. Here's where Ariel's story becomes a cautionary tale that every trader needs to understand. By 2021, he was making $200,000, $500,000, even $800,000 months. Success on this scale creates a psychological trap that destroys more traders than any market crash ever could. The illusion of invincibility. Ariel freely admits he got cocky. He moved into an expensive apartment, bought an expensive truck, bought diamond chains and watches. But the real danger wasn't the spending, it was the psychological shift that came with it. He started to believe that the strategy was foolproof, rather than understanding that he had simply been trading in the perfect environment for his approach. This is what I call environmental blindness, the failure to recognize that trading strategies are environment dependent. The buy red, sell green approach that made Ariel millions in the raging bull market of 2020 to 2021 was perfectly suited to that environment. But when 2022 arrived and the environment shifted, that same strategy became a liability. The psychological trap wasn't just overconfidence, it was strategy rigidity. Ariel had learned a set of tactics that worked brilliantly in one type of market, but he hadn't yet developed the psychological flexibility to adapt when conditions changed. This is why many traders who do extremely well in bull markets give back all their gains and more when the market environment shifts. But here's what separated Ariel from the countless traders who blow up during these transitions. He had developed what I call percentage-based risk management. Even when he was losing money in 2022, he wasn't taking the kinds of catastrophic risks that destroy accounts. He was still thinking in terms of portfolio percentages, not absolute dollars. More importantly, he maintained his learning mindset. Instead of stubbornly sticking to tactics that were no longer working, he stepped back and studied traders who had longer track records: Peter Brandt, Jason Shapiro, Linda Rashka, Lance Breitstein. He recognized that his early success had been built on favorable conditions, not superior skill, and he needed to develop a more robust psychological and strategic framework. The evolution from day trading to swing trading psychology. The transition from day trading to swing trading represented a complete psychological transformation for Ariel. Day trading had fed his need for immediate gratification and constant action, what he honestly acknowledged as an adrenaline junkie mentality. Every day required a new bright idea, a new way to make money. The psychological pressure was enormous. Swing trading demanded a completely different psychological approach. Instead of needing to be right every day, he could focus on being right over weeks and months. Instead of relying on position size to generate returns, he could rely on time. This shift from position size pays you to time pays you represents one of the most important psychological evolutions any trader can make. But the transition wasn't easy. Ariel was accustomed to making money every single day. Moving to a system where he might not see profits for weeks or months required tremendous psychological discipline. He had to learn to find satisfaction in the process rather than in daily P&L swings. The key psychological insight here is that swing trading allowed Ariel to separate his self-worth from daily market performance. As a day trader, every red day was a personal failure. As a swing trader, individual losing trades became data points in a larger system. This emotional detachment is crucial for long-term trading success. Ariel also discovered that swing trading better matched his natural psychological tendencies. He could do his homework at night when markets were closed, analyzing Finviz data, identifying the strongest groups, finding stocks with good earnings and sales growth. This systematic approach appealed to his analytical nature much more than the reactive, high-pressure environment of day trading. The psychological benefits extended beyond trading itself. Swing trading gave him mental space to think strategically rather than reactively. He could take his dog for a walk, get a haircut, live a more balanced life while still having positions working for him. This work-life balance actually improved his trading performance because he was making decisions from a clearer, less stressed mental state. Risk management, the psychology of survival. One of the most revealing aspects of Ariel's psychological evolution was his approach to risk management. Early in his career, he made a crucial mental distinction that most traders never grasp: the difference between the trades you take and the trades you don't take. Ariel developed what he calls a no big red policy. This wasn't just about position sizing. It was about psychological positioning. He knew exactly where he was wrong before he entered any trade. If the trade went against him, he would exit at a predetermined level, usually risking about 2% of his portfolio. This meant that his most common trades were small green, small red, flat trades, with occasional home runs. This psychological framework eliminated the emotional decision-making that destroys most traders. There was no debate, no hoping, just a little longer thinking. The trade either worked according to plan or it didn't. This binary approach removed the psychological stress that comes from constantly evaluating whether to hold or fold losing positions. But the real psychological insight was his approach to scaling into positions. Ariel would only add to positions that were already working in his favor. This meant he was never averaging down into losers, a psychological trap that destroys countless traders. Instead, he was building larger positions behind strength, which aligned his position size with his conviction and the market's confirmation. The toast trade that cost him several $100,000 demonstrates the mature psychological approach he had developed. Instead of viewing it as a failure, he understood it as part of the system. He had predetermined that he would hold as long as the stock stayed above the 200-day moving average, accepting that this meant either a moderate gain or the potential for massive returns over time. Simultaneously, he was shorting weak stocks as the market environment deteriorated. This wasn't emotional revenge trading, it was systematic adaptation to changing conditions. The psychological maturity here is remarkable. He could hold losing longs while profiting from shorts, understanding that both positions were part of a larger strategic framework. The mental framework, thinking like an institution. What truly sets Ariel apart is his institutional mindset, despite being a retail trader. He thinks in themes, groups, and relative strength rather than individual stock stories. This psychological approach mimics how professional money managers actually operate. When he identifies a strong group, semiconductors, solar, quantum computing, he doesn't just trade one name. He builds a watch list of the best stocks in that group and waits for proper setups. This systematic approach eliminates the psychological pressure of trying to pick the one perfect stock. His approach to fundamental analysis reveals mature psychological thinking. He doesn't try to predict earnings or analyze balance sheets in detail. Instead, he focuses on what institutions care about: earnings growth, sales growth, and technical strength. He's positioning himself alongside institutional money rather than trying to outsmart it. The psychological insight here is profound. Most retail traders try to be contrarian, looking for stocks that are cheap or oversold. Ariel learned to be a momentum trader, buying strength and shorting weakness. This aligns him with the natural flow of institutional money rather than fighting against it. His use of tools like FinViz demonstrates systematic thinking over emotional decision making. He's not scanning for hot tips or following social media buzz. He's identifying groups with the best relative strength, then finding the best stocks within those groups based on objective criteria. This institutional mindset also shows up in his position sizing. Rather than betting big on single ideas, he builds diversified positions across multiple names in strong groups. When the group works, multiple positions contribute to profits. When it doesn't, predetermined stops limit losses across the entire theme. Psychological discipline, the foundation of success. Perhaps the most important psychological insight from Ariel's journey is his commitment to continuous learning despite his success. Even after reaching eight-figure profits, he continued studying traders with longer track records, taking courses, and refining his approach. This psychological humility is rare among successful traders. Most develop what I call success blindness, the belief that their current approach will work forever because it has worked recently. Ariel maintained what Carol Dweck calls a growth mindset, always assuming there was more to learn. His approach to lifestyle and spending reveals mature psychological thinking. Despite earning millions, he became more frugal over time, not less. He recognized that the market could take away money much faster than lifestyle expenses could spend it. This psychological relationship with money, seeing profits as tools for future opportunities rather than rewards to be consumed, is crucial for long-term wealth building. The discipline extends to his daily routine and self-care. Following advice from other successful traders, he prioritized sleep, nutrition, and stress management. He understood that trading decisions made from a compromised mental state would be inferior to decisions made from a clear, well-rested mind. His willingness to adapt his trading style based on market conditions shows psychological flexibility that most traders lack. When day trading stopped working, he didn't stubbornly persist or blame external factors. He evolved his approach to match the new environment. This psychological adaptability is what separates career traders from those who experience brief success, followed by long-term failure. Markets change, but the principles of risk management, continuous learning, and emotional discipline remain constant. The bigger picture, what this means for every trade. Ariel Hernandez's journey from prison to millions isn't just an inspiring story. It's a masterclass in trading psychology that offers lessons for every trader, regardless of account size or experience level. The first lesson is about starting mindset. Ariel succeeded partly because he had nothing to lose, which eliminated the fear that paralyzes many traders. But you don't need to start from prison to develop this mindset. You can create it by only risking money you can truly afford to lose and by viewing trading as skill development rather than income generation. The second lesson is about environmental awareness. Ariel's early success came during an exceptional bull market, but his long-term success came from recognizing when conditions changed and adapting accordingly. Every trader needs to understand that strategies are environment dependent and develop the psychological flexibility to evolve their approach. The third lesson is about systematic thinking versus emotional decision-making. Ariel's evolution from gut-based day trading to systematic swing trading demonstrates the power of process-driven approaches. The most successful traders develop rules-based systems that remove emotion from critical decisions. Perhaps most importantly, Ariel's story demonstrates that extraordinary trading success isn't about finding secret strategies or having insider knowledge. It's about developing the psychological framework to consistently apply sound principles over time. Risk management, continuous learning, emotional discipline, and strategic adaptation. These are the psychological foundations that separate career traders from those who flame out. The emotional payoff of Ariel's story isn't just the money he made. It's the transformation from someone society had written off to someone who built genuine expertise and wealth through discipline and continuous improvement. That transformation is available to any trader willing to develop the psychological foundation that makes it possible. The question isn't whether you can replicate Ariel's exact returns, The question is whether you're willing to develop the psychological discipline that makes consistent profitability possible. Because in the end, that's what separates the traders who build lasting wealth from those who remain perpetual beginners, always searching for the next quick fix instead of building the mental framework that actually works.